Good morning, ma'am. Before we start our lesson for today, we will introduce ourselves first. My name is Mary Christine Jane Bactad.
I'm Eileen Natividad and
I'm Jonalisa Necor.
I'm Edmar Samera.
So, in international financial management, or also known as international finance, is the management of finance in an international business environment. That is, trading and making money through the exchange of foreign currency. The international financial activities help the organization to connect the international dealings with overseas business partners, customers, suppliers, lenders, etc. It also used by government organization and non-profit institution. During the post-war years, the GTAA was established to improve trade. GTAA stands for General Agreement on Tariffs and Trade, which is a legal agreement between many countries whose overall purpose was to promote international trade by reducing or eliminating trade barriers such as tariffs or quotas. To remove the trade barriers notably over the years, as a result of which international trade grew manifold. The financial participation of the traders, exporters, and importers and the international transactions flowed significantly. It started when different countries started liberalizing, when countries agreed to open doors to each other and traded. The advancement of technology and liberalization resulted in the idea of financial management both domestically and globally. Components of international financial environment. International financial environment is totally different from domestic financial environment. International financial management is subject to several external forces like foreign exchange market, currency convertibility, international monetary system, balance of payment, and international financial markets. The first one, foreign exchange market. Foreign exchange market is the market in which money denominated in one currency is bought and sold with money denominated in other currency. It is an over-the-counter market because there is no single physical or electronic marketplace or an organized exchange with central trade clearing mechanism where traders meet and exchange currencies. It spans the globe with prices moving and currencies trading somewhere every hour and every business days. For example, Ecuador, El Salvador, and Panama have decided to dollarize, that is, to use the US dollar as their currency. Sometimes, nations share a common currency. The best example of common currency is the euro, a common currency used by 19 members of the European Union. With these exceptions duly noted, most international transactions require participants to convert from one currency to another when selling, buying, hiring, borrowing, traveling, or investing across national borders. The market in which people or firm use one currency to purchase another currency is called foreign exchange market. Number 2, current convertibility. Foreign exchange market assumes that currencies of various countries are freely convertible into other currencies, but this assumption is not true. Because many countries restrict the residents and non-residents to convert the local currency into foreign currency, which makes international business more difficult. Many international business firms use counter trade practices to overcome the problem that arises due to currency convertibility restriction. So how is currency convertibility done? In international transactions, currencies of different countries are used. Some of the world's currencies are acceptable in all types of transaction throughout the world. These are called convertible currencies. Example are US dollar, Swiss franc, French franc, British pound, Germany mark, and so on. Other currencies are called inconvertible currencies because these are not accepted by all countries in all types of transaction. The international status of country's currency depends on two things. The first one is the country's balance of payment position, and the second one is the confidence of the rest of the world in the country's currency, which depends largely on the stability of the currency in recent past. Currency convertibility is of two types, on current account and on capital account. If a currency is convertible only on current account, it is called a partly convertible currency. Such as currency is accepted for all current transactions such as export of goods and services and unilateral payments and receipts. However, if a currency is convertible on capital account, also it is called a fully convertible currency. Such as currency can be used to repay the external debt. For example, if rupee becomes a fully convertible currency, India will be in position to repay her external debt in rupees rather than in foreign exchange. Capital account convertibility is also likely to encourage greater inflow of financial capital from the rest of the world and thus improve the country's balance of payment position. Third one, international monetary system. Any country needs to have its own monetary system and an authority to maintain order in the system and facilitate trade and investment. India has its own monetary policy and the Reserve Bank of India (RBI) administers it. The same is the case with world. It needs a monetary system to promote trade and investment across the countries. International monetary system exists since 1944. The International Monetary Fund (IMF) and the World Bank have been maintaining order in the international monetary system and general economic development, respectively. International monetary system refers to a system that forms rules and standards for facilitating internal trade among the nations. It helps in relocating the capital and investment from one nation to another. It is the global network of the government and financial institutions that determine the exchange rate of different currencies for international trade. It is a governing body that sets rules and regulations by which different nations exchange currencies with each other. With the growing complexity in the international trade and financial market, the international monetary system is necessary to assign a standard value of the international currencies. The rules and regulations set by international monetary system to regulate and control the exchange value of the currencies are agreed upon the respective governments of the nations. Thus, the governments and stands may affect the decision-making of the international monetary system. For example, change in the trade policy of a government may affect the international trade of goods and services.
Number 4. International financial markets. International financial market born in mid-50s and gradually grown in size and scope. International financial markets comprises of international banks, euro currency market, eurobond market, and international stock market. International banks play a crucial role in financing international business by acting as both commercial banks and investment banks.
Some examples of financial markets includes the stock market, bond market, and other commodities market. Financial market can be further broken down into capital markets, money markets, primary markets, and secondary markets.
Number 5. Balance of payments. International trade and other international transactions result in a flow of funds between countries. All transactions relating to the flow of goods, services, and funds across national boundaries are recorded in the balance of payments of the countries concerned.
Balance of payments track international transactions. When funds go into a country, a credit is added to the balance of payment, or BPO. When funds leave a country, a deduction is made. For example, when a country exports 20 shiny red convertibles to another country, a credit is made in the balance of payment.
Difference between domestic business and international business. Domestic business. Domestic business refers to the business where economic transactions are conducted within the geographical boundaries of our country. The buyer and seller in domestic business belong to same country. It is limited to territory. In domestic business. It is very easy to conduct business research. Domestic corporation conducts its affair in its home country or states. International business refers to the business where economic transactions are conducted across border with several countries and the world. The buyer and seller in international business belong to different countries. It is quite wide. In international business, business research is very expensive and hard to conduct. International business refers to the business where economic transactions are conducted across border within several countries in the world. In domestic business, buyer and seller belong same country. In international business, buyer and seller belong to different countries. Domestic business is limited to territory. In domestic business, selling produce remain an alternate. International business, selling produce change. Quality of products or standard may be lower. International business, quality of a product or standards are expected and enforced. Domestic business, it is very easy to conduct business research. International business, research is very expensive and hard to conduct. It deals with a single currency. International business, it deals with the multiple currencies. Capital investment in lease. International business, capital investment in hard. There are few restrictions. And domestic business. International business, there are a lot restriction on international business. The business, the nature of customers in domestic business is homogeneous. International business, the nature of consumers in international business is heterogeneous. And domestic business, the degree of risks are low, and international business, our degree of risks are high.
International finance is a branch of financial economics that deals with the monetary interaction that occurs between two or more countries. This section is concerned with topics that include foreign direct investment and currency exchange rate. It also involves pertaining to financial management, such as political and foreign exchange, that comes with managing multinational corporations. Importance of international finance. International finance helps in calculating exchange rates of various currencies of nations and the relative worth of each and every nation in terms thereof. Number 2. It helps in comparing the inflation rate and getting an idea about investing international debt security. Number 3. It helps in ascertaining the economic status of the various countries and judging the foreign market. Number 4. International Financial Reporting System facilitates comparison of financial statements made by various countries. Number 5. It helps in understanding the basis of international organization and maintaining the balance among them. Number 6. International finance organizations such as IMF, World Bank, etc. mediate and resolve financial disputes among members nations.
The world is working together to compete globalization, with most companies, both major conglomerates and small startups, doing business across the planet. This requires the study of international finance. Managing said finances properly will prevent fines, tax problems, improper planning with respect to currency conversion, and proper initial planning of business within foreign nation. This is highly complicated and extremely important thing to understand. The foreign nation will have various and highly complicated laws which you will likely know little about. Their taxes rates, how taxes are reported or not reported, and how taxes from revenues earned there are reported back to your home nation are a major hurdle. The idea of having to conduct business in the foreign currency exposes your business to another set of risks that are volatile in the best of situations. Finally, understanding the foreign nation economy and all those complexities is a daunting task. So yes, you will likely have a team of specialists to help, but you will need to understand these people by having a general knowledge of how some of it works. International finance is an important tool to find the exchange rates, compare inflation rates, get an idea about investing in international debt securities, ascertain the economic status of other countries, and judge the foreign markets. Various economic factors help in making international investment. And that is our lesson for today. Thank you for listening, ma'am. Thank you. God bless.